Market update in commercial real estate 2025. There's a lot of turmoil, a lot of uncertainty, a lot of question marks. Make sure you're subscribed to our channel because we're going to be sharing market updates similar to this as we navigate all this different rough waters and uneasiness with what's happening in the economics and the political spectrum right now. So let's dive in with our first guest, Chris Litzler, and see what's happening in the world of commercial finance. Chris, appreciate you being here, brother.
Yeah, bud. Good to be with you. Good to be with everybody. We sit here on April 2nd. Happy Liberation Day, as they're saying.
Hey, it'll be very, very interesting to see what happens with the tariff announcements, right? There's a lot of speculation on that over the course of the past few weeks. How is that going to be impacting products coming into the United States, the U.S. dollar and the strength of the U.S. dollar economically across the entire world? A lot of crazy stuff. So it'll be interesting to see what happens there. Let's go back a little bit and let's say 6 months ago. 6 months ago, Fed started dropping interest rates, the federal daily trading rate. That has not positively impacted the 5-year Treasury and the 10-year Treasury. Can you speak a little bit about what's going on that front?
Yeah. So as we sit today, 10-year UST, call it 415-ish, 5 years, 390-ish, and Fed funds or SOFR is around 430. Okay. We got an unemployment rate around 4.1%. We got an inflation rate around 2.8%, and we still do have positive GDP growth, reported GDP growth. So, all signs, all of those stats seem like everything's okay, right? But, the question is what's lingering under the hood and what do, new changes in trade policy do to any of those metrics? Slow down growth, increase unemployment, increase inflation. So those are kind of the things that we're thinking about. The rate that you mentioned, so Fed funds rate, which is equivalent to SOFR in our world, has come down from about 530. So you're down 100 bips since they started dropping rates last year, but you're really not seeing that impact longer term bond yields, right? Those are set by the market and supply and demand and growth and inflation expectations. So the 10-year Treasury has kind of been in this range from 415, 420-ish to 440-ish for the last 90 days. And it's just looking for a little bit of direction on where we're going long term.
So the federal funds rate is the daily borrowing rate that banks borrow money at, right? And although that's gone down, all that really means for us as consumers is we're making less money on our money markets, on our certificates of deposit, but also potentially paying less on like credit card fees and any sort of variable rate short-term loans, right? But from a long-term perspective or midterm, like 5-year, 10-year Treasury, the rates have actually gone up, which means that the markets are indicating that there's something working underneath the hood, to your point, right? And although the Fed utilizes the Fed funds rate to move up and down to combat inflation and unemployment, those numbers are pretty steady. So what that means is the rates really aren't probably going to go anywhere unless something pretty catastrophic happens, right?
We like to say unless something breaks. And, you saw a brief thought of a break last year when you had this like very brief, Japan carry trade unwind, right? It happened like over a weekend and there was a ton of volatility, but then it just kind of went went away, right? So it kind of felt like something was going to break. It didn't yet, right? We have seen historically, typically when the Fed cuts, they cut hard and they cut fast. So we'll see. Nobody's alluding to anything like that, but they never usually do.
So the question becomes, if tariffs increase, the thought there is inflation's going to go up, right? If there's more tariffs, the cost of goods are going to be more. It's going to cost more money. And and that gets passed down to the consumer, which creates all inflation. If that happens, the Fed's unlikely to reduce rates, right? It's actually more likely that they would increase rates if inflation ends up going up. The dichotomy here is if something does break, then unemployment increases. And they don't want to see unemployment increase along with inflation increase, because now you just have to kind of stay in the middle, right? So what are your thoughts on that?
Well,
Read on tariffs
that's
and
yeah,
how that's going to impact these rates.
that's right. Look, we've been dealing with Trump for a while now. First thing I always say is let's not overreact until we see what actually happens,
Yep.
right? There's a lot of negotiation, there's a lot of phone calls in the background that we're not privy to. Let's see what actually comes out, and then let's see what happens very shortly thereafter, because you've seen him do this before. He backs off, somebody capitulates. So I, j- I'm not sure where we're going to land, but I'm not going to speculate until we see what actually comes out today at 4 o'clock. Um, you know, what you mentioned, I would agree with except for one thing. So you have tariffs go up, which could increase um, inflation. If you have but if you have the unemployment rate go up, that would decrease demand, right? So if you have less demand, then that would offset some of that inflation, right? That's what happens in a recession. People stop spending. Consumer spending is such a high percentage of GDP,
Mm.
and that would actually offset a lot of that
And so
tariff
in that
increase.
scenario, if both of those things increase, both inflation and unemployment, then the Fed would look at it from like just maintain the status quo. They wouldn't be increasing or decreasing rates, right?
You would probably more likely to see them cut. I think they care more about the
Yeah, I
unemployment
agree.
rate than inflation. Now, and then I guess it depends on the extent of the inflation, right? They have this 2% number, right? 2%, 2%, 2%. We're at 2.8. Who's to say it's two? Is it 2.5? Is it three? Is that really all that bad compared to, you took unemployment from 3.5 and you go up to 5, and if it starts creeping, right, they're gonna be that's gonna weigh heavy on them.
Yep, yep, I agree. So there was a couple things happened. I've seen this going around all the internet, and it's a chart from January 31st of this year. So about 60 days ago, Freddie Mac came out with this line chart of showing the number of seriously delinquent commercial properties, specifically multifamily properties, um, in the United States. And this line chart has increased, where today there are more seriously defaulted mortgages on multifamily properties than there were in 2008, 2009 at the last peak, which was the most it's ever been. So there's more today than there's ever been. Now there's also more properties today, right? A lot of things have been built over the past 15 years. So I think proportionately it's not as high, but numerically, quantity wise, it's more properties in seriously delinquent. So one, if you could define what does seriously delinquent mean, and two, how are you reading that and how are you responding to that, and what are the markets saying to that and the agency lenders?
Okay. So seriously delinquent would just be over 30 days late.
So they
Right?
missed a mortgage payment, and
More
it's been
more
30
more
days
yeah,
since they missed a mortgage payment.
more than one, right?
Okay,
More than one payment,
got
right?
it.
Okay. So let's think of where there's problems. Okay. Most of the stuff that had long-term permanent financing put in place either was refinanced over the last 5 years or was financed on long-term money over the last 10 years. There really shouldn't be any problem there, right? Low rates, the fundamentals are all fine. To the extent there is delinquency issues, it's typically, some either event, right? Hurricane, flood, something that's not in somebody's control, or sponsorship problem, right? Poor management, lack of oversight, like not enough resources to keep the property going. So for the most part, anything that was permanently financed should be okay, right? So where are the problems? The problems are twofold. One is on anything that is delivering, right? So new construction, the costs are up, interest carry is up, your refinance interest rate is higher than you would have estimated, and you're delivering in some of these major markets where there's just currently too much supply, right?
Meaning 2 or 3 years ago or 4 years ago, when these developers, builders bought this land, they were running projections based on what financials looked like back 3, 4 years ago. And then rates have obviously skyrocketed over that time. And now that they're being delivered, they're not able to hit anywhere near their pro forma numbers.
That's right. Two things. One is you probably had costs go up during your construction period. Two, most of these construction loans are floating rate, right? So if they
Yep.
started at SOFR 15 bips and you're now at SOFR 400 bips, right? That's a massive swing in your interest carry, and you probably burn through your interest reserve, right?
Yep.
So that's the first. So your basis is up. Two, you may be offering concessions or lower rents because you're delivering in a time when there's a bunch of supply, right? And three, you're trying to refinance out this construction loan and you can't get the proceeds that you would have expected, A, because your rents are down, B, because your expenses are up, right? Taxes are up, insurance is up, payroll's up,
Mhm.
R&M's up, everything's up, right? And your coverage, all else equal, even if you had the same NOI, you're qualifying for less proceeds, right?
Yep.
So a lot of these construction loans are in trouble. Not necessarily that the debt is impaired, right? That if you were to sell the project, the debt would be impaired, but they are entering into some sort type of extension. Maybe there's a default because they can't service it. Not that the loan is at risk, but there might be a default there, right? So that's your first piece. The second thing is, you know, the properties that were purchased in 2021 and 2022 with floating rate loans, with bridge loans, they are in trouble. One, even with, even properties purchased at the peak, even with a very clean business plan execution, still at risk, right?
Mhm.
If you bought something at a 4 cap, put some money into it, raise rents, like you just can't outgrow 2% expansion in cap rates, right? So those have risk. We're seeing those kind of try to get uh we're those are we're seeing some workouts with those bridge
I was going to
loans.
say, what are the lenders doing in this capacity? Are lenders, do they want to take the properties back? Are they working with the borrowers? What's the solution if somebody's watching this and they're having a tough time with one or two of their properties and they're trying to figure out do I hand it back, right? Do I recapitalize it? Do I refinance it and hold for the next 5 years? Like, what are the options that they
Yep.
have that you'd advise on?
Sure. So the first thing that I would advise on is take care of your property, right? Get the property performing, right?
Agreed.
At 90% plus occupancy, you have much more options, negotiating power than if you're sitting at 65% occupied and the thing doesn't cover, right? So that's the first. If you can get the property performing, it's likely that you can at least service the mortgage, right? Or get close to servicing the mortgage. The first thing you want to do is you want to try to keep your mortgage current, right? So that's the first piece. To the extent that you have most of these loans had extensions built into them, right? 3-year loan, couple of 1-year extension options. So for the most part, you're still able to extend. You got enough term left, but the very early stuff is starting to hit that 5-year term. So if you have an extension available, it's probably your best option. It may require a curtailment or a principal pay down or funding an interest reserve or buying a new cap, but that's probably going to be your best option. It allows you the most flexibility, right? Because you can sell it without having a big prepayment penalty. It's probably your least cash out of pocket, right? If you were to refinance it, you'd probably have to pay the loan down, right? So that's probably your best option. If you are out of extensions, um, If you're out of extensions, but you at least have your occupancy there, there's there is enough liquidity in the market where there would be availability to refinance your project. It just depends on how much cash in. If you are out of runway, property's not performing, you really have very limited options besides a sale, and the sale is probably going to wipe the equity.
Yep. What are you seeing from, as rents, maybe grew a little bit but not as much as potentially what was projected, and expenses have gone up like crazy. And then obviously there's compression because of the cap rates on how much leverage people are going to be able to get on those new loans. What are the best options out there? Is it agency? Is it life insurance companies? Is it CMBS loans? Is it local banks? Who's giving kind of the most preferential terms? I would think leverage is most important to a lot of these people a lot of these developers who have projects coming online, or investors who have, maturity things coming up. So trying to get out of bridge loans, trying to get out of variable rate loans. What are you seeing right now are like some of the best options for the most leverage?
Yep. So leverage is typically constrained by coverage,
Yeah.
right? So to get the most proceeds, you need the lowest possible rate and the longest amortization, right?
Or interest
Um,
only, right?
or interest only, right? So uh, Fannie, Freddie, HUD tend to be the highest leverage options, um, and the best pricing, longest amortization, right? But your property needs to fit, right? So, you know, in general, we say 90% occupancy for 90 days, right? Good enough seasoning, good sponsorship, decent markets, right? So that's your best option in general. If you can tolerate lower leverage, right, then you'll have life insurance company options. Um, and then
Are those rates pretty substantially better than the agencies because they're lower leverage and perceived lower risk?
Yeah, not really. Not really. It's probably equivalent to some of the lower leverage agency pricing tier three, tier four agency pricing is very
Okay.
difficult to beat. Um, yeah. So those are your options there. And then to the extent that you can't fit it in those buckets, then you have banks, you have credit unions, you have CMBS, and you have some private credit that's entering the market. So that's the equivalent of like the DSCR type loans in the residential space. So those are your options there. Um, where
So somebody,
we're always kind of trying to advise though is you got to maintain your flexibility, right? Because if
that's what I was going to get to.
you're bringing in a lot of equity to right size the loan, well, now you have LP, you have your money that just came in, right? And now you're entering into 5 years of defeasance, like, it's just something you want to be aware of, right? You're really kind of buckling up for the long haul.
So kind of some of those levers that you're looking at. And listen, we just went through this. We had one variable rate loan um, in our entire portfolio, but it was also on our biggest property. It was very painful for the past couple of years. And you just lined up a loan for us with CMBS, and it was interest only, 5-year term, and got us the most leverage. We did some rate buy down stuff too, which made it make more sense for us to get a little bit higher leverage. Um, but that was our best option at that time. And so I think some of those variables that were going through my head and your head as we're figuring out which offering do we go with was which gives us the most leverage, and finding something that was um, what's the DSCR ratio? Is it 1.0? Is it 1.1? Is it 1.25? That's going to constrain you. Another thing to look at is how much in escrows need to be put up, right? With each of these different lenders. What does that look like? Can you buy down the rates? I think pretty much all of them you can, but obviously the rate matters. Interest only versus 25-year AM, 30-year AM. And then also, what is the balloon, or when is the maturity date, right? When is our balloon due? And what's the prepayment penalty if you want to try to get out of that sooner? Um, it seems like the general consensus is rates aren't moving too much either way anytime soon. Obviously, we talked a little bit about if unemployment really jumps up, they might slam down some rates and it might make sense. But, I think the flexibility piece is a big deal. And am I missing anything on some of those variables to look at when people are saying, hey, because I'm a big believer, man, if you can get out of higher interest rate debt and put in something lower rate, fixed on a longer amortization schedule and or interest only in order to just kind of ride out the next 2, 3, 4 years until the supply, because all the supply dries up after this year, right? And then there starts to be this heavy compression on the current supply that we have as there's more and more demand for that supply. And there's a lot of projections that rents are going to grow pretty dramatically over the course of the second half of this decade, right? 2026, 2027, 2028, 2029. And, if you can ride out and let rents bump up, make sure the property is performing and stabilize in that 90, 93, 95, 97% occupancy range, controlling the controllables. I love that you had focused on that because I do think that's the biggest thing that anybody can do, that they can take control over and have that true ownership over their asset. Because that's what gives you more options than anything else. Are there any other variables I'm missing that people should be looking at?
Yeah, the first, the one that you didn't mention is recourse, right? A lot of these bridge loans at least had completion guarantees or carry guarantees. So getting off the recourse and removing the contingent liabilities from your balance sheet are gonna give you some more options just down the road. So that's
Yep,
one. A
great point.
bank or credit union, depending on loan size, right, is probably full recourse, right? So while it may be, the cheapest to close, most flexible. Um, you know, there's a recourse component there, which a lot of guys are averse to, and probably rightly so. Um, the only other point that I'd say, yeah, time is your friend in real estate, right? You get 3-year deal, 5-year deal, 7, 10, whatever. But in general, time solves problems in real estate. So fixed rate, longer duration, um, it tends to be your friend. It only comes to bite you when you have to exit and there's some sort of penalty. So
And
we
that's when
are,
you realize a loss. I mean,
that's right.
you don't realize the loss if you can ride this thing out for another 20, 12, 24, 36 months. It gives you, to your point, time is on your side. And that to me, of not being able to return investor capital or having my money tied up a little bit longer, having to manage this thing a little bit longer, in most scenarios, right? There's obviously an opportunity cost, but in most scenarios, in my mind, that's a better worst case scenario than realizing a loss today of millions and millions of dollars.
Yeah, that's right. Think of it, I guess think of it this way. When do you get in trouble in real estate? You typically get in trouble not when you have permanent financing in place, you have some sort of event, right?
Yep.
Some sort of maturity. So taking that maturity risk off the table that's typically what spoils deals.
Yep. I agree. All right, brother. I'm going to close out with this one. You've got a tranche of $10 million to deploy. What's the most opportunistic place to look at deals over the course of the next 12 to 18 months?
Um, s- so the opportunity right now is finding some of these deals that are in really tough shape, coming in and rescuing those deals. You can get really big. A, you can get great basis. B, big returns on some of these deals that are in trouble. Um, I'll give you an example. There's a big deal in town that underwent like a unfortunate situation with a big basically lightning strike on a garage collapse, has a Fannie loan on it. So unfortunately, like that's going to go back to Fannie, and then they're going to auction it off, right? So a property that at one point sold for or was valued at 30 some $1 million could sell for 5, right?
Wow.
So there's some good deals to be had in these bad situations. So having liquidity, being able to move quickly, having a lot of experience, having construction background, GC on the team, there's a lot of opportunity on some of those distressed deals.
Yeah. That's kind of what I'm seeing too. I'm seeing, not kind of, that's exactly what I'm seeing. And, there's so many operators that are in a point of distress right now where if you can salvage one, their credit, and two, some of their equity, right? If not all of their equity, they will kind of hand over the keys to you and you can step in, buy a large percentage of ownership in that LLC and bring them the cash, because a lot of people, man, had easy access to capital over the past 4 or 5 years that has gotten a lot more difficult, right? And there's a lot more work that goes into it. And especially like, even for us, we're having a lot more conversations in order to raise the exact same amount of money than we were before, because everybody was just loose with their investment cash before, and anybody could have raised money for deals back then. We have a track record. We've been in business for a long time and at a high level for a long time. And we can still raise money, but it's definitely a lot more work. And I can definitely see people who didn't build that muscle of developing a base of investors and that are now in a tight spot and cannot raise money because they never developed a skill set to raise that capital. You can step into those deals and find yourself, to your point, at a great basis with great upside and control over that deal in a lot of ways, instead of then get into a really, really good opportunities and really, really good properties. So I love that.
There are, if it's harder for you to raise capital, imagine some of these onesie twosies syndicators that raise money and they're not having any success calling capital.
Yep.
Right. So if you can't call capital, and then you need to make a member loan, right? These guys just don't have enough liquidity to do it. So there's opportunity there.
For sure. For sure. Awesome, brother. Well, dude, thank you so much for being here. Always a pleasure chatting with you. Always get a ton of great takeaways. I tell people all the time, man, of everybody that's like on my power team who's not on a W-2 role in my organization, you are probably the most valuable. So I appreciate you, man.
I appreciate you, brother. Always good to see you. Talk to you soon.
All right, brother. I'll see you in Cleveland soon.
Thanks.
Got some great insights from our buddy Chris Litzler on the financing side of things. And he had spoken about construction as well, and a lot of the new construction that's being delivered over the course of this year, and then how there's not a lot of new construction being delivered in 26, 27, 28, and beyond. And so I've got my good buddy Josh Dixon here. Josh is one of these contractors who really gets it from both a third-party construction standpoint and from an owner, investor, and operator standpoint as well. So Josh, appreciate you being here, buddy.
Yeah, man. Thanks for having me on.
So let's dive into what you're seeing right now over the course of the past 3 or 4 months of new administration, interest rates from a Fed fund side being reduced, but actually 5-year and 10-year Treasury being increased. What's going on with supply chain? What's going on with material? What's going on with costs? I want to dive into the labor side of things with deportation of a lot of Hispanic workers, right? That are a lot of times in the trades, and what that looks like and how that's impacting all this stuff. So, man, let's start out first with what have you seen over the past 90 to 120 days in both the supply side and the labor side of the construction world?
Yeah, so let's start with the supply chain. That's a little less prevalent right now. It's a lot of speculation of what's happening, but those things take time. So we know that the tariffs have come on. What I predict, my biggest fear in the tariffs right now are more so lumber. I see that as the biggest hurdle, depending on if we continue stay back and forth with Canada and places where we buy a lot of our spruce and Canadian lumber. Now, on the same flip side, if we open up and deregulate some, we have plenty of timber here in the States. But when you're making that transition, it's my biggest fear is the lumber side right now. When we got into this back with COVID, the supply chains, things shutting down, it was your electrical, your plumbing. There's going to be some steel tariffs. I don't see any. I mean, we have a lot of construction ramping up in the States, so I don't see any major holdups yet, but it's still too early to tell, in my opinion. I know a lot of people are worried about it, and when you start tacking these kind of numbers onto a tariff, it is definitely going to have some kind of impact. But what the true impact is, I don't think we've been able to see that yet on my side. We're still being able to get materials. We're still being able to get lumber. Maybe even a slight decrease in lumber, but that a lot of what's going on right now, it's probably, as hurricane season ramps up, this is kind of a slow time anyway on a lumber prices.
Got it. So from tariff standpoint, we get a lot of our lumber from Canada. Obviously, if tariffs go up on Canada, then Canada's got to eat some of it, right?
Yep.
Those suppliers are going to have to eat some of it. But then also us, right, as consumers of that lumber are going to eat some of that too. How do you see that impacting construction costs moving forward?
I think it's just going to do more of the same. We're going to be in kind of a stalemate. We're already in a lack of supply as it is. And so one or two things, either people don't build, which we have to at some point, and we'll get more into that when we get into immigration, but we have to at some point just keep up with the housing demand somewhat. And the rents are just going to go up. And there's going to be more people maybe staying in the same dwelling, joint ventures that way. But with Canada, like I said, that's my biggest concern. We're going to have to eat that just like we did in COVID. It didn't stop people. And my projections of what I think would happen from my experience, I think people's going to pay the price. Right now, when we're building spec homes, which we haven't done as much lately, but this is something we had already saw this trend last year when we was wrapping up our spec homes. The people that are buying right now aren't your $300,000 starter home. They're people that's that $400,000 or $500,000. They're smart with money. They've got some savings. You're moving more of those houses. So I think people that have money and people that have been wise with their money, they're like, hey, we're just going to go ahead and do it. Why wait? So I think that's what you're going to see on the residential side. Your big players, which I'm not, but these big guys that are building lots and lots of big developments are definitely on pause, definitely on hold, which I think is a good opportunity for a seasoned but smaller investor to be smart and to be patient and go ahead and be working, finding the good deal, not trying to get every deal, just making the best of what you have, date that rate, and make sure you don't get upside down, buy it right, team up with the right people, and go ahead and get more product on the line. Because when it does break through, you need to have either some property ready to go, already entitled, ready to break ground, or you need to have some stuff that, okay, now the increase is got, on the rents, we can get the decrease on the mortgage payments and be ready to go.
Yeah, man. I don't think you're gonna be able to build a house for under $300,000 in the next couple of years, right? Like it's
for sure.
The costs keep on going up, and what does that do? And I, to your point, I've had this conversation with a couple of folks just in the past week here in Charleston. We're seeing the same thing where the lower price point stuff, they're very price sensitive under that $300,000, whereas the stuff that's over $1 million here is moving very quickly, and those folks are less price sensitive because obviously they have more disposable income in order to put towards their property. So it's interesting to see how this dichotomy has started to create, where we thought things low cost would be moving like crazy, but it's not really happening. In fact, that's sitting pretty slow right now, and a lot of those people are turning into renters.
For sure.
Or staying as renters because of it. So if you own assets, it's a pretty good position that you're in, especially over the next few years. And there's going to maintain a large pool of demand in those affordable rental rates over the next few years. So yeah, it's interesting.
I think you'll see a bigger divide.
I'm saying it again.
I think you're going to see that bigger divide of, those $500 to $1 million. Those people are going to keep doing what they're doing, and the other people are going to act out of scarcity. And you're going to see more of them turn, like you said, into renters or townhomes, as my hopes. Bigger divide for sure.
Yep. What are you seeing from a labor standpoint, right? Like a lot of, I saw something on the news that there were over 5 million, Social Security numbers given to illegal immigrants, people, undocumented immigrants that came here to the United States over the past 4 years. Of those folks, right, they're being stripped of their Social Security numbers and being sent back to whatever country that they came from, or starting through the process of how to do it legally moving forward. A lot of those immigrants are Hispanic immigrants that came here to work construction jobs and labor-intensive jobs. Are you seeing the impact of that with these Social Security numbers being pulled away and with immigrants being sent back to the countries that they came from? How is that impacting the labor force in construction?
Yeah. So just some quick numbers. 34% of construction labor is Hispanic or Latino. So I think that's going to be a huge, huge upset. Another thing that you're seeing is, there's a 30% decrease in the younger generation getting into construction. The average, I think it's 54% of construction workers are from 42 to 61. And so, pretty alarming when you see that
aging generation for sure, right?
Yeah. So you see the new generation is not coming into 50+% of them, 40s to 60s. There's a 62% lack of skilled labor. And then you have, 34% of the labor force being Hispanic. It is going to be definitely impactful. So, there's two sides of every coin. Some people are like, okay, then if there's projected like 11.2 million undocumented immigrants. And so if we take them out of the equation, Trump's administration has said, okay, this is going to help with the housing demand, but it's going to we're going to decrease the supply chain. So I think you're going to see basically a stalemate. It depends on how fast we start seeing these deportations. Last time I looked, it was only like 1,500 a day or something. I haven't kept up with it a little bit, but it's not fast enough that it's really wreaking havoc. But we're already, you've done construction. I've been in it for years. We already have a problem with everyone we have here now, not being skilled, not having enough, too much. Even though we're behind, we still have so much building. You say this guy, hey, I need you, and he's like, well, I've got these other jobs over here I got to finish, and there's no leverage there because there's a lot of work out there, not enough workers. You're going to take more of those workers, so I believe you're just going to see another increase in prices and a bigger strain on demand.
Yeah,
for sure.
Yeah. We're seeing it in real time, man. How difficult has it been to get these crews, and what can we do to better attract crews that can stay committed to our projects?
Yeah. So one of the things that we're trying to do, and I've been reading on a lot of your construction workers are really trying to move into the new technology, doing more with less, putting GPS systems on equipment where one man can set in equipment instead of having a guy at a transit, a guy holding a reader, and a guy in the machine. You set $60,000 GPS system up on a piece of equipment, and now one man can do everything in a climate controlled cab. So making their environment better, using technology. So 3D printers, they have 3D printers and drones. You load it up with your PDF file. It's like one of these little Roombas that goes through your house and vacuum, and it'll lay out a whole job site for you. So I think you're going to see a lot of that. We're looking at, even though we're really small, we're looking at all the ways we can introduce AI into construction. But to the point, like incentivizing, being able to, I think having that personal relationship where you're working with them, they know that you're going to take care of them. They know that even if you get in a spot, you're going to be paying them. You're going to be, so like finding out where one sub stops and another sub starts, and making sure that those guys play nice together. Just creating a great work environment, because it's not always about the money. I've had a lot of jobs that I've took over the years, and it just wasn't worth the stress. And they're the same way. Everybody's the same way. They want a clean job site. They want camaraderie. They want to feel like they're part of that ecosystem and that team and just not disposable. So finding those things, we're looking with Hispanic community. We look to kind of evolve with them. There's some new things we're trying to order and get taken care of, like earbuds, that translate in real time. So they're not having set for $450. We can get some earbuds. They can have a set. We can have a set. I speak, they speak, and it helps those language barriers. So little things like that's what we're focusing on right now. Just trying to do that and have long-term relationship with subs. So as long as you're doing a good job, we're going to keep using you. And they're not wondering where that next job's going to come from. We're not beating them up on price every time. We're like, this is what we can pay. You can do it for this. You can have the next 10, 100, 200, 500 jobs that we do, as long as you can keep up and you hold up your end of the deal and we hold up ours.
I love it. Are you seeing that pricing has gone up on labor pretty substantially or not yet?
Yes. So some trades are going up. I've actually seen a slight decrease. You're starting to see some framers in certain areas that's been overbuilt, like Nashville. So we're about an hour outside of Nashville. So I have a lot of my Nashville guys that are calling, hey, you got any work? Usually it's your framers. And so with Nashville starting to build up so fast and now everybody's putting a pause, now they're reaching out to me. So I think we're starting to see a slight decrease in our prices on framing. Your specialty stuff, more like your wiring, is the biggest jump that I've noticed on an upward tick, and plumbing a little bit, but mainly your electrical is on an increase. The rest of it is your skilled labor. As far as just normal guys, that's holding maybe ticking up $1. The average price for a construction labor is like $35 right now. But we're able to get some pretty good guys, and we're actually bringing in a lot of young guys right now, and we're just trying to train them. We're trying to say, hey, this is a projection of where our company's going. We're looking at going to trade schools, picking these guys up, maybe even doing some onboarding courses and being like, this is where we want you to be. This is the role we want you to be in. Give them an opportunity. So that's kind of where we're focusing on, but that's a long-term play.
I like the controlling aspect of it, of like, hey, we're dealing with all these outside economic factors. At the same time, we're going to control what we can control in this situation, which is let me attract and let me hire for good attitude, and I'll train for skill sets and tactical and technical understanding, right? And so you got to do a little bit more work. You're not finding the people who are immediately skilled right out of the gate, but now they're also not disenfranchised or jaded by whatever old job that they had. They're able to come in, you're able to train them the right way and how to do the job properly right out of the gate. And then they're with you because you made that investment in them. There's a lot of loyalty that builds up. So that's awesome, man. So for folks who are looking at potentially taking on new construction projects and new development projects, is this a good time, or is it let me see what happens with the landscape a little bit more?
I think after the years I've been in it, at one point I would have told everybody to just hold off. It's scary. You don't know. But the truth is you never know. Things were going great and then COVID hits. Nobody knows what tomorrow's going to do. My advice is to stay in your lane. And like you say, only get a couple of degrees out of your lane. And then partner up with people that are better at the other things that you're not. And then there's a lot of deals out there. So there's tons of land. There's tons of rehabs that can be done. There's tons of apartments that need renovation, houses that need flipping. So I would just say, make sure you're buying it right. It's just like anything. We chose townhomes just because we can be patient. We can buy the right piece of property at the right price. We can do the entitlement of it. So we're already bringing value to that property before we ever break ground. So we can sell that to another investor. Once we get done, we can rent those, we can sell them, we can lease them, we can sell them to a big buyer to buy all of them, or we can sell them to individuals. So just buy it right. Watch your exits. and just make good decisions at the beginning. I think it's a great time. It's not going to necessarily be a home run, but you can definitely get some good first, second, maybe even third base every now and then. And I think on the horizon, things are going to get better 26, 27. So just being stagnant and doing nothing is definitely not going to project you ahead. So just be that slow and steady and swing when you can.
And just staying active, man. I think just like the continuously staying in motion is a big deal. So that's awesome. Josh Dixon, appreciate the updates on the construction side of things regarding the market and where things have been, where they are today, and an outlook on where they're going. So thanks, brother.
Yep. Thank you. Have a good day.
Now I want to shift gears back to the tax side of things. And my good buddy Joe Viery, owner of U.S. Tax Advisors Group, is on here sharing with exactly what we can expect from Trump's tax cuts. So we're going to be diving into accelerated depreciation, right? Bonus depreciation, some of the new IRS guidelines that they're bringing out, and also some of the energy tax credits. So Joe, appreciate you being here, buddy.
Great. It's good to be here. Thanks, Tim.
Hey, so bring me up to speed on, or bring us all up to speed on what you're seeing and what the expectations are right now as we sit here in April of 2025. I know Trump made some announcements last month and kind of his like State of the Union type of address. And then at the same time, it hasn't passed yet, right? And it needs to go through the whole bill writing cycle and get approved by Congress and all those things. But what are we looking at, and what are some of the expectations for 2025 from the Trump tax cuts and from the IRS perspective?
Well, that's a good question, Tim, and that's the big buzz in my world, which is accelerated depreciation, which everybody should know. It's cost seg or cost segregation. And basically, what happened is during that speech he made, I don't think it's called State of the Union, but whatever he called it, and I think it was March 5th or March 4th. Everybody should know about that the 2 hour, I believe, discussion he had in front of everybody, in front of all the lawmakers, and of course it was televised. Was that he did actually mention bringing back 100% bonus depreciation, and that
so
is
why is that
important?
What exactly does that mean? Maybe you could just kind of educate everybody on that.
Exactly. And I've been doing this since 2007. And for the first 11 years, we did not have anything close to 100% bonus. So we never had a slowdown. It was just, cost seg was on fire. All it means is this, is that out of the total bucket of money that you get when you accelerate your depreciation, if you do not have bonus depreciation, then the benefit you get the majority the first year. Like I'm just going to guess because all buildings are different, like 80%. And then the 20% of depreciation, you're going to get that, but over the next 5 years. And I get a lot of questions why. It's a math problem because what we're giving the client, the owner of the building, and we're giving them buckets of 5 and 7 year property, a bucket of 15-year property, and a bucket in residential of 27.5 year property. So it's just simply taking the math and combining all of those timelines, putting them in a blender, blend it on low for 5 minutes, and what you get is you get depreciation. You get the most of it in year one, but you get trails. Now, are trails bad? No, but if you're an astute businessman, you want your deductions, you want your benefits as soon as possible. You don't want to wait around 5 years if you can help it. So what bonus does is it takes off those trails, and just bada bing, everything we find, it's boom. All of that bucket of money you get in the tax year you do the study. If you don't need all of that deduction, then it follows you forward. So you're never going to lose it, but it's certainly nice to have your bucket full of depreciation, because one never knows in real estate what's going to happen tomorrow. Somebody might come up and they may want to give you a ton of money to buy your property. You know that story. And bottom line is you might need every single deduction you can have to offset your capital gains taxes.
So let's go back and just high level. If you're not familiar with depreciation, accelerated depreciation, and cost segregation studies, that's essentially every property out there is depreciable, right? Land is not depreciable, but every property, whether it's single family, multifamily,
Commercial.
storage,
Yeah.
warehouse,
Any type.
any type of property is depreciable on the building value. And what the government says is that over time, this property is going to go down in value because you're going to have to replace things like the roof and the foundation and the electrical and the windows and the HVAC units and all the different components. And so what a cost segregation does is it line items all those things. Because right now the government just says, put it all into one lump sum, and then we're just going to divide it out over 27 years if it's residential, or over 39 years if it's commercial real estate. So what you guys do is you guys come in and you say, hey, all right, well, instead of this commercial property that you bought for $1 million and you can depreciate over essentially 40 years, that's $25,000 a year. Like, guess what? The HVAC is not going to last 40 years. The roof's not going to last 40 years. The interior trim is going to have to be replaced in the next 40 years. Like, there's all these things that end up being 5-year property, 7-year property, 15-year property. And you're able to then segregate those out, and then you lump those all together, and you can front end load a lot of the depreciation, right? Is the idea. And the thing with bonus depreciation is it lets you front end load it all to the first year. And that's been phased out over the past several years. I think this year is what, 40%?
Well, if we're 25, I'm sorry, 40% in 25. You're right, 2025.
And then the rest of it gets trailed out over those, I think, what, in the next 4 years, correct?
5 years. But it depends on the math.
5,
Four to 6 years. Depends.
Okay. And so by bringing bonus depreciation back, it front end loads it all to being able to take that this year in 2025. And you've seen this with not just real estate, but bonus depreciation also impacted people buying airplanes and software and all sorts of things that allow people to have front end loaded deductions, which gives them higher time value of money. So now I can take this money that instead of paying it to taxes, I'm reinvesting it in my business. I'm buying more assets. I'm improving property or building more property, investing more dollars, which then stimulates the economy even more is the idea of it. And that's why cost segregation and accelerated depreciation and bonus depreciation exists. And so what you're saying is, it's been phased out over the past few years. It's supposed to be phased out and just go back to normal terms in the next 2 years. And if Trump reinstates it, it's kind of a shot in the arm. It's a great way of a great boost of adrenaline to the investment community, because now you're going to see more dollars coming off the sidelines and being invested because the tax benefits that it brings about.
Exactly. You hit the nail on the head. I couldn't have said it better, Tim. I mean, this is really advantageous to have it all. Don't get me wrong what I said before. It is advantageous to be bada boom and get all of your deductions the year you do the study. So if you bought a building in 24, we'd be looking at and you filed your 24 taxes, we're looking at tax year 25. Bonus depreciation, like you said, in 25 drops down to 40%. So out of that bucket of money, I'm going to take 40% out, and then the rest of that is going to be over the next, let's say, 5 years on average. So it's a lot better to get the whole bucket. Let's be greedy.
Yeah, well, it from self-interest, right? It makes a lot of sense. I'd much rather be taking that money instead of paying it to Uncle Sam and never seeing again. I'd rather be investing in more projects. And it also stimulates the economy. It creates more jobs, creates more property taxes, creates more revenue that you're paying contractors, which now they're paying income taxes. Now they're paying for supplies and materials and all these things. And there's a reason that these tax incentives exist. It's because it stimulates the economy and it stimulates investment and keeps the wheels of capitalism greased and continuously moving forward. So it's a good thing for everybody. It's a good thing for the economy. It's a good thing for us as individuals, as investors, and as people who aren't, and even if they're taxpayers, it's good for everybody to have these kinds of things in place. And I think it's a great tool that the government uses without cutting taxes, without even talking about tariffs or any of those kinds of things. It's or adjusting interest rates. Like, there's a handful of tools that the government can utilize to really stimulate the economy and generate more GDP, gross domestic product, in the United States. And this is a great way of doing it because it helps business owners like you and me be incentivized to go and hire those additional employees, buy those additional assets, spend dollars on marketing, and create more jobs and get the wheels turning more. So that's awesome. Tell me a little bit about also the green energy tax credits. I know that's another big thing that is kind of in the works, and maybe you can educate everybody on that and tell us what are the benefits of these green energy tax credits.
Well, here's my observation from, like I said, being in the industry since 2007 and dealing with thousands of building owners, is that my primary target market is value add clients. And of course, what does a value add client do? They get a crappy building and they put money into it and they fix it up, they improve it. So
Yep.
when they improve it, the odds are, and everybody can figure this out, that you're going to somehow, some way increase the energy efficiency of the building. Using less energy. Well, you should all know what this is. Insulation, windows, doors, HVAC systems, water heaters, appliance, light fixtures. All of those go into what my engineer is looking for to see if you've gone over the threshold needed to get either the tax credits or to get the extra depreciation. So there's two types of studies out there that we do. One is called 45L. That's for single family homes or multifamily. I believe it's up to 4 stories, which is weird, but that's what it is. If you do have over 4 stories, there's another study called 179D, and 179D is for bigger multifamilies and for all commercial buildings. You can get 179D. It's a little bit different between both. The 45L is a tax credit. You can get between $2,000 to $5,000 per door on the tax credit. On the 170/90, it's like cost segregation. You're just getting another depreciation expense, a big depreciation expense. I think it's 581 per square foot. 581 or 583 per square foot is what you get as the extra depreciation. So we're talking in many cases large numbers here, and I feel that there are many accountants that don't know somebody like U.S. Tax Advisors Group who can do these types of studies because they're so powerful. I find that very, very, very few owners of real estate who are value added and made improvements are using these tax credits and using this new, and it's huge. One huge part of it is we can go back 3 years. Even if you sold the building 3 years ago, as long as 3 years ago you did the work, you can get the tax credits as long as you can
Wow.
prove to me. Now I have to, I'm the worst one because you're going to have to prove to me what you did. It can't be like, oh yeah, I put it in HVAC. I don't remember what kind I put it. No, you have to show me what you put into that building because otherwise we can't do our work. So bottom line is I think it's a low threshold of work required by the owner, but the value is so high. And we do the same thing. We give everybody an estimate, and the estimate we give them is, hey, do we think you're going to qualify or not? If we say the answer is yes, we'll go forward. If the answer is no, we won't move forward. So it's no cost to the owner of the building.
Love it. All right. So let's go back. So there's programs, whether the residential properties and under 4 units or the commercial properties over 4 units and in other varying
Over
asset classes.
4 stories.
Okay. Not only, well, we'll come, I'm going to come back to some of the financing benefits as well, but when you're renovating one of these units, the thing is almost everything at Home Depot and everything at Lowe's and everything, all these suppliers, they're all energy rated anyways, right? And so when you're installing these things into your properties, you're probably already putting energy efficient light fixtures, appliances, low flow, shower heads and faucets and toilets into your property anyways, without realizing that you could qualify for these energy tax credits. Where if you have your receipt, or you can go to Home Depot or Lowe's and ask them for all your purchases, assuming that you tagged it to a certain property. And obviously the HVAC type stuff, you could just go in and take a picture of it and understand, is this an energy efficient model or not? But like all these things are improvements that people are already making to their properties. And by doing that, they can qualify. When you say a tax credit, a credit is actual, if you owe $50,000 to the government in taxes this year, the credit directly reduces that dollar for dollar, correct?
Correct. That's how it works.
So if you get $2,000 to $5,000 per unit and you have a 4-unit building, you're talking about somewhere between $8,000 to $20,000 of a deduction, not on your taxable income, but on your actual tax liability, it's reducing it by that much money, correct?
Correct. And now let's take it to a multifamily. You have a 100-unit multifamily building. Do the math. Time if you qualify for the 5,000. We're not going to get into the weeds of the difference between 2 and 5. It has to do with timing, meaning if you bought a building, if you did the work, not bought it, if you did the work 3 years ago, it's $2,000. This is the last year of 2,000. Then it all goes up to the new range, which is between 2,500 and 5,000. And we feel that we have techniques where we can get people to qualify. So in other words, I know a lot of accountants out there say, "Oh, you're never going to qualify. Forget it." No, there are ways to work around any of the regulations out there. There are legal ways to work around them. So most owners will qualify. And if you're talking 5,000 per 100 units, wow.
It's a lot of money, right? It's
And
a
then,
lot of money. It makes a
you get,
big difference.
and then
To
guess
not only
what?
you, but also your investors, the other general partners in any of these deals. And, it's a way to have a huge win when a lot of owners are struggling in real time right now because interest rates are up, taxes are up, insurance costs are up, energy costs are up, labor costs, material costs, management isn't doing as much as they should be. And you're having these conversations with your investors of, hey, we're trying to get it there. We're trying to stabilize it. Like we're facing a lot of headwinds. This is a great win that you can now bring to your investors and to your partners and show them, hey, we're on our way getting it there. But also, guess what? We got this huge tax credit that is being passed forward to you, on an equitable basis because of all the improvements that we've made over the past few years. So that's a huge, huge benefit. And there's no cost, right, to doing it. People reach out to you guys step in, you guys give them an estimate and at no cost. And then once you put those things in place, that's when they pay you, right?
Exactly. And one thing too to keep in mind is that some buildings can qualify for both 179D and 45L. And that now that you take that 100-unit building, if it qualifies for both, forget about the 5,000 per door. Now we're talking another $500,000 on the 179D. So I mean, we're talking big money here. I mean, we're not talking about sometimes when we do cost set on small buildings, we're saving the guy maybe $20,000-$30,000. But man, we're talking about over $1 million on a multifamily of 100 units, that type of a building.
That's amazing. And then from a standpoint of, just so you guys know, there's certain green credits or green benefits that you can get through the agency lenders, Fannie Mae, Freddie Mac, where if you're making these green improvements, they'll actually lower your interest rate in a lot of cases too. Now, you need to prove that you put in new thermostats. You got to prove that you put in energy efficient appliances, and you got to prove all this stuff. But you're doing it anyways. You're able to lower your interest rate by doing so. You're able to now get these tax credits by doing so. It makes a big difference economically when a lot of the numbers have been pretty tight over the past few years. It now takes a losing deal and it makes it a winner, or takes a winning deal and makes it even a greater winner, a home run, right? By being able to implement something like this. Let's go back to what you said about the commercial stuff. When you said $581, I think, per square foot.
$5.81 is
$5. Right, $5.81 per square foot. So if I own a warehouse, or if I own an office building that's 50,000 square, let's see, 100,000 square feet for easy numbers. This is a further. It's not necessarily depreciation, but it reduces your tax liability, your taxable income on that project, right? It's a deduction as opposed to a
deduction or an expense. Yes, against income. Yeah.
Got it. And is it use it or lose it this year, or does it roll over to next year if you don't use it all?
No, well, all of the strategies that we're involved in are net operating losses, which move forward over time.
Awesome, man. That's amazing.
But now one important factor though is you can't time your losses though. In other words, if you don't need them all, you have to take what you need to wipe out your income taxes, and then those will flow over to the next year. But you can't say I'm only going to take 30,000 of my 200,000. No, you can't do that.
I like the idea of controlling what you can control in your assets and in your properties, right? We're talking about market updates. There's a lot of speculation None of us have a crystal ball. And at the same time, there are things we can do right now, today, with our portfolio to put us in a better spot financially, put us in a better spot operationally, right? Put us in a better spot with our investors from a peace of mind standpoint, and having more control over these multi-million-dollar assets that we own. And so I love having this as a tool in the tool belt that all of us should know exists, and I think very few people actually take advantage of it. It's a very big deal. So that's awesome. How can people get a hold of you?
Simple. Our website is USTAGI. Ustagi, some people call it, but USTAGI.com, and you're going to find a link on the homepage. It'll say, "I want an estimate," and you just click the link. It takes you to the estimator. Put in your property information, the basics, and then we'll respond back within 48 hours, 2 days. We'll respond back with the estimate and the fee.
I love it. Joe Viery, appreciate you being here, man. Thank you for the market update. It's going to be very exciting to see some of these tax code and things get renewed over the course of the next few months here. And as soon as they do, as soon as we hear a little bit more, I'm going to have you back on here. So thank you for being here, buddy.
Excellent. Thanks, Tim. Good job.
As we navigate this uncertainty and all these question marks in what's happening economically and politically, we'll be sharing more and more market updates with you each month. So make sure you're subscribed to our channel. If you have any questions on any of these things, put it in the comments section, and we will share each of these experts' contact information with you so you can reach out to them directly if you have any questions for them. So in the meantime, check out this video on exactly how we're sourcing deals in today's marketplace. The exact marketing techniques we're utilizing, not only to go hunting for deals, but also fishing for deals that come straight to us right now, today in 2025.